to Market Catalyst. I'm Julie Hyman. After battling through a New Jersey transit commute, I'm here in New York City in this studio where we are 30 minutes into the U.S. trading day. So let's get to the three market catalysts we're watching this hour. First up, earnings season in full swing. We'll have full coverage throughout the show of the big movers you need to watch. Plus, we'll have more on airlines as flight cancellations continue following the winter storm. And we'll bring you today's top analyst calls on Wall Street. All that and more coming up on Market Catalyst. Let's take a look at what's going on in the markets here today, because we have an interesting divergence between the Dow and the other major averages. It has a lot to do with earnings, which we'll be getting into throughout the next hour. But the Dow right now is down nearly 400 points, about 0.8%. The S&P 500 is up about 0.4%, and the Nasdaq is up about 0.75%. So you can see that divergence playing out. Before we dig more into that, I do want to get to some of the other moves that we are watching closely here today. We are seeing bond yields kick up very, very slightly here today. We continue to watch what's going on with the dollar down versus the Japanese yen. Pretty esoteric normally, but this has really been a move that has caught a lot of people's attention here. So this is the dollar falling versus the Japanese yen as of late, which causes a bit of a ripple effect around the globe. And Michael Burry, the investor, is warning that this actually might be a bad move for U.S. stocks. So that's something to continue to watch. We also, of course, continue to watch gold after going above $5,000 an ounce. It's seeing a little bit of a pullback here today. Well, I mentioned what's going on in the divergence in the major averages. This here is the Dow, and if we equal weight the Dow, we see what's going on. A lot of it is down to UNH, United Health Group, which was out with numbers that missed estimates here. There is also a reporting that the Medicare reimbursement that's going to be proposed for UNH and other Medicare Advantage providers is going to be lower than expected. So those things weighing on that stock and other stocks within that group. Boeing, we're going to get more details on that as well in a little bit, coming out with numbers. So it's earnings really that are weighing things down within the Dow Jones Industrial Average. On the flip side, we got pretty good performance here coming from large cap tech ahead of many of these companies, including Apple and Microsoft and Meta and Tesla, reporting earnings later this week. So that's kind of the balancing act that we're playing here. If you look at the sectors within the S&P 500, it's also very clear. Healthcare is falling the most and tech is gaining the most. So that's the balancing act today. But let's get more into some of these companies that have reported earnings. One of them, American Airlines. It missed fourth quarter estimates, but issued a better than expected forecast for 2026, projecting a strong year ahead. Joining me now is Steve Trent, independent aviation specialist. And Steve, it's great to have you here. The promise of American has been, we're going to sort of catch up with our competitors in premium. And did this quarter show that they're making progress in that catch-up?
Thank you for having me on. I do think they absolutely made progress in the quarter in terms of what we saw with premium bookings. The fourth quarter itself, you did have a couple of hiccups. The government shutdown. In the Caribbean, you had some of the airspace around Venezuela closed for a couple of weeks. Right. If you kind of strip those out, and you look at the guide that they put for 2026, it looks like they're making very good progress.
And they say first quarter revenue should rise by 7 to 10%. How does that comport with what you were looking for from them?
Yeah, we thought we were going to see something more in the mid-single digits, a little bit of a slower start. So the 7 to 10% is very good, and that's on top of 1.25 some odd points impact, for example, from the winter storm. Where we're still seeing, of course, some residual effects. So when we think about the premium growth, what bookings look like in February or March, I think this is a very good setup for the rest of the year, and looking at how they're going to distinguish themselves between them and United and Delta. You have a lot more earnings growth in this name, for example. Clearly an inflection point if I've ever seen one.
Okay, so here's my question on that. So when you're deciding where to fly, when people are deciding where to fly, what is driving those decisions? And how is American sort of putting its finger on the scale, so to speak? Because I think a lot of people, when they are deciding where to fly, it's going to be price, it's going to be schedule, right? Is American improving that, or are they focusing on amenities, or all of the above?
Yeah, so look, price is still important. I would argue price today is a little bit less important than it was 20 years ago. If you look at the U.S. population, roughly 40% of U.S. households have annual income of $100,000 or more. That's 75% of air travel comes from that segment. So when people look to fly today, definitely schedule's important, what kind of amenities they get, how it's going to build in terms of loyalty program, and global capillarity. What sort of international and regional exposure do they have versus their competitors? How much of that metal is theirs directly? How much of that is coming from global loyalty partners? So all of those things, I think, weigh in. And today what we're seeing is an even bigger move in terms of premium. And that's where I think Americans making some exciting gains.
So what have they done to kind of sow the seeds for that?
Well, a new co-branded card program with Citi. That's getting the ball rolling in terms of them having some stickiness with core customers. 2 retrofits of existing planes and new equipment coming in that does have more premium seating. That's what is driving things today. And if you look at the network airlines versus the discount airlines, I think we really move away from that cattle car concept and cheap ticket concept, and now people want a nice onboard experience. And basically it's centered around who's buying. Is the broad consumer purchasing these tickets? Not really. As I alluded to earlier, it's relatively wealthy consumers are doing the flying, and they don't want a lousy seat. They want a nice seat on the plane.
Yeah. Fair enough. You mentioned the storm, of course. So what do we hear from American on that front? And among the airlines, who was the most exposed to disruptions from this storm?
Yeah, absolutely. When I look at the FlightAware data, American was more exposed than others. You look at what happened in Dallas, Fort Worth, of course, and Charlotte. And then, of course, here in the Northeast, JFK and Philadelphia, American had a big impact. Of the big 3, they had the most cancellations in terms of a percentage of their daily service. They had over 9,000 flights canceled from this storm. Apparently, it was unprecedented in the carrier's history. And we're not done yet, because we started with a clean schedule for everybody, and now that schedule had assumed we would have equipment and crew where they're supposed to be, and they're not there. So this will be a couple of days to work through, but certainly versus the other carriers, American has been seen a lopsided impact from this storm.
Gotcha. Do you expect to hear some of the other carriers also talk about it, or is it really an American problem, to your point?
Yeah, so I think this disruption is significant enough that I'd be surprised if no one else talked about it. And when I sort of thumb through mentally the FlightAware data, for example, JetBlue is kind of up there. Delta Airlines was also kind of up there in terms of what kind of delays they saw. Maybe Southwest Airlines a little bit as well. But relative to DAL or American, Southwest, let's say they benefit from having a relatively simple operation. They just have one fleet type, and they're almost entirely domestic. So they don't have complicated global schedules that have seen some dislocation.
And speaking of Southwest, they report tomorrow, right? And they're also just ending their long-time boarding procedure. So what do you think is the future and outlook for Southwest?
Yeah, it's an interesting one. On one level, they have a formidable strategic shareholder that's been making important changes to the boarding process. They have strategically moving towards a look and smell that looks somewhat more like a network carrier. International code shares with different airlines. For example, changing the boarding procedure, no more bags fly free. I think if you're a Southwest, however, relative to the other 3, the main thing on my mind is the EBIT to free cash flow conversion. If we think about pre-pandemic, Southwest was doing $3 billion each of EBIT and free cash flow, for example. You look at today's EBIT to free cash flow conversion, it looks really poor versus what it used to. In fact, Southwest has been burning cash. whereas the big three have been generating free cash flow.
Can they get back there?
I think I think time will tell, how these initiatives play out. I think on the revenue side, it looks like they're on the right path. In terms of getting to more of a look and smell like a network airline model, seat mile cost is going to be the thing to watch over the next couple of years. As they onboard new equipment, maybe there's going to be nuances in pilot salary, maybe they need new flight simulators, depending if they, assuming they go that way.
Right.
So I think the seat mile cost side of the fence is a big question mark. But the EBIT to free cash flow conversion that they used to have, I don't see them getting back to that. And then an opportunity to lever up, which they're doing. But I think longer term, we have to watch the EBIT to free cash flow conversion for Southwest.
Gotcha. Steve, good to see you. Thanks so much for coming in. Appreciate it.
Thanks for having me.
Well, sticking with the airspace, the latest results from Boeing show the planemaker generated cash for a second straight quarter. Boeing also reported a 57% jump in sales as its recovery continues. Joining us for more, Tony Bancroft, a portfolio manager at Gabelli Funds, covering the aerospace and defense and environmental services stocks. It's good to see you, Tony, as always, to talk about Boeing. I know that you have been a believer on this one, so maybe validated to some extent by some of the numbers here. So what were some of your takeaways from what we heard from Boeing?
It's great to be with you, Julie. I think overall, progress on increasing production, getting the production lines in order, supply chains sort of battened down. And, I think over the long term, you're going to see these certifications, are going to be a big positive for the company. They talked about having both variants of the Dash 7 and Dash 10, which they talked about before this year, certified, and the 777 looks like deliveries are going to end up at the end of this year, hopefully the 777X. So these are all, positive momentum. Some a little bit of challenges still on the defense with the KC-46, so the new tanker program. They took some charges there. But I'd say overall, it's a pretty good quarter and pretty good report, and looking forward to hearing what more of that to say on the call at 10:30.
Yeah, Tony, and it seems like that accounting change related, or that write down related to that tanker program is what may be responsible for the stock going down, given that the other numbers that you mentioned look pretty decent. For people who aren't familiar with that, what is that sort of a legacy of what Kelly Ortberg, the CEO, is trying to sort of clean up? How much attention, how concerned should people be about that?
Yeah, the KC-46 is essentially a new tanker for the Department of War and international customers, and there's growing pains on every new program, and there were historically some issues with the boom. It's a new technology. How the boom operates much different than the boom that I tanked off of in the F-18. It's much more digital than historically, so more complex. And then some other structural issues, not safety of flight, but just essentially how they can the manufacturing process. They're working through those. Again, this is going to be a very long. My grandkids could be tanking off of this aircraft in a few years down the road. So I think overall it's probably not a big deal, and it's just some follow-on charges they've been taking on the defense businesses for the last few multiple quarters, but likely that's going to continue to improve. It's one of our largest holdings in our Gabelli Commercial Aerospace and Defense ETF, ticker GCAD, and it's done very well for us, and I continue to expect it will do well over time.
Tony, what do you think is the sort of biggest potential for upside with Boeing? We keep sort of waiting for them to work out the various issues that they've been trying to work out over the past few years. Once they do, is it just that being done that's going to be the thing that's going to unlock more upside for the stock? Or are you waiting for them to come out with some of the long-standing products, for example, they've been working on?
Yeah, I think that's, there's a couple of things there. I think the biggest is people still understand they talked about upping the 737, which is the most important program for them, to 42 a month. But still, they're not back where they were, at their previous peak of about 52 a month. And there's a lot of operating leverage that goes into production, as you know. You have all this overhead. If you're producing at under rate, you've got these people working that are not at full production capacity, and you're essentially just paying for a line that's not optimized. So as that starts to improve and you start seeing more throughput, it's just going to increase the profitability. And it's a very simple math problem, like many businesses. And you're going to start seeing the profitability improve and the growth there on the commercial side. As well as the wide body business, the 787, you're starting to see more throughput there as well. They talked about eight a month, going to 8 a month now. And then the 777X is going to come online, and along with the other variants of the 737. So you're going to start seeing deliveries increase, and then the defense businesses are essentially incrementally improving and getting back to historic margins. So you're going to start seeing a business that was much more what we knew of Boeing back in the mid late teens. So I think that's sort of the driver. And then the follow-on program. Remember, there is a duopoly, and they have the follow-on programs for the next generation narrow body plane, which at some point they're going to start talking about and working on. And that's all things being equal with the we were seeing the traffic numbers and traffic projections for 2026 and beyond. It's still outpacing, global GDP. So I think we're going to see some good things out of Boeing in the future.
Tony, while I have you, I want to ask you about another potential government shutdown, this one a partial shutdown. But are there any repercussions for defense spending?
I'd say I think that the defense spending, particularly right now, what's going on in the world, is probably a bipartisan issue, and I don't think either side of the House wants to see a holdup in that. I think that what happened last time was not a good look at anyone, and I don't think they want that again. And there's probably a way they're going to be able. There might be a short, a few day delay or a gap there, but I think they'll have a solution relatively quickly, at least on the defense spending, to maintain that going forward.
Tony, thanks so much. Have a good day.
Thanks.
Coming up, results from United Healthcare disappoint as also the Trump administration reportedly makes a surprising recommendation for Medicare reimbursement. Shares of United Healthcare sharply lower after forecasting a drop in revenue this year, which would make its first year-over-year sales decline since 1989. The insurance giant was the worst performing member of the Dow in 2025, falling about 35% over the course of the year. Let's bring in Jared Holtz, Mizuho America's healthcare equity strategist, to talk more about this. And this is before we even get into the reports on Medicare reimbursement rates, Jared. But just when you look at the numbers themselves, what to you holds the most responsibility for not just the disappointing results today, but the weakness that we've been seeing in United Health?
Hey, Julie, how are you? I think it's multifaceted. I mean, some of it is just stemming from prior year disappointments, and so this just adds another layer to that. I think from a sentiment standpoint, that's really important to consider. It's not like this was the first piece of bad news we've gotten for the industry or for the stock. When you look at the quarter, it was actually not so bad. The MLR was better than expected. There were some bright spots to kind of talk about. But then when you fast forward to 2026, which is more important, and then 2027, it just doesn't seem like there's that much upside to numbers. And that was really what a lot of investors were going on into earnings, was that you were going to see some shift in earnings higher and maybe get a conservative guidance with room for upside. And I just think that's sort of off the table near term.
And it seems as though Optum, which had been one of the sort of profit generation engines of the company, and it's sort of a subsidiary of UNH that provides pharmacy benefit services, but other types of services too. It seems like that is now shrinking. Is that also, I guess that's not necessarily unexpected, but is that something that also is going to mean things are going to be slower?
I think both sides of the business, big picture, are shrinking a bit. I think this is sort of United's approach in terms of, getting the overall business to better align with the cost structure. It's been very, very difficult, I think, for so many companies in managed care to predict the future. We've seen some really big numbers misses out of all of them pretty much over the past couple of years. And so it's not that distinct to see shrinking of the business. I think the profitability is okay. But again, when you talk about what needs to happen for the stocks to start working, I think we need to start seeing some real earnings leverage coming out of both pieces of the business, and that's just not happening.
Jared, taking a step back, right? When you talked about MLR, for folks who don't know, that's the medical loss ratio. It's the percentage of premiums that United Healthcare collects that it's paying out to pay for healthcare, and that has been a challenge for it and other insurers. Is there anything that these guys can do, something that would be good perhaps for all of us, to get the cost of healthcare down in a way that would help their margins? Are they working on that at all?
I think they're trying to. I mean, part of the 2026 number is a little bit more hemorrhaging of the patient population that's higher risk. I think the company is trying to downsize in certain areas of the market, which have been either problematic, difficult to predict, all of the above. And so I think that's already starting to happen. The MLR has been very hit or miss. There's been a difficulty or a complexity with respect to predicting patient movement and activity. Not just United, I would say for most of the companies in this sector over the past few years. Some of that stemming from COVID, which put a lot more patients into the system following the pandemic. There's some typical demographic shifts, but this has been the toughest piece, I think, of investing in managed care, is that the companies haven't really had visibility. And if they don't, it's tough to think that investors do.
But if they're not covering the sickest people, I mean, maybe it'll be lower cost for them, but ultimately won't it be higher cost for the system?
It's possible. I mean, a lot of what investors are talking today about is, can United, can they kind of like shrink the cost structure? What can they better do to align revenues and expenses? And part of that is cutting benefits. So I think a lot of the patients on United plans or otherwise are going to see, because of what's going on in the industry, they're going to be paying the same but getting less. I think that maybe from a societal standpoint, the most problematic piece of all of this is that you're going to see patients that pay X but get way less than they used to in the past.
That does seem problematic. Jared, and then there is the other big story that we are watching, which is that the Medicare Advantage reimbursement rates are now expected to be less than expected for 2027. How important is that for you? I mean, UNH is a huge company, so I don't know how important on a relative basis Medicare Advantage is. Can you help us understand that, and then the effect it's going to have throughout the industry?
Yeah, it's really important for UNH, for Humana, for CVS, and for a couple others as far as what it does to numbers. I think a lot of the street models sort of implied or assumed that Medicare Advantage rates would go up next year by something around 5%, give or take. And so to see CMS come out and say that they were going to reimburse that category on a flat year over year, it just pressures earnings even more, right? Because the spending at the companies, probably the way that the companies are setting up for 2027, I believe probably assumes some sort of uplift in terms of reimbursement. Now that looks to be flat versus 5%, you're 15 to 25% of the business for several of the companies in this category is going to be impacted. Again, I think the number, it's tough to tell on a true numbers basis for a little while, because these patient populations on a per company basis seem to change a decent amount, but it's going to have a big impact. I think that's why for the next couple of years, even though United, I think, is being fairly assertive in saying that they're going to grow earnings, I think it's going to have to come from other areas of the business, including cost cutting, to get them there.
You know, Jared, in having this discussion with you, whether it's about Medicare Advantage or about the fundamental business, I mean, I think we're all pretty aware that healthcare, the health insurance system in this country is pretty broken. We've had the discussion in Washington before, but it seems to be coming to a head in a different way. But does it feel like anything is going to change here?
I don't think so. Not over the near term. I mean, we talk about the brokenness of the system constantly. It just doesn't seem like there's an outcome that's going to happen anytime soon that allows all of the verticals within healthcare to act well simultaneously. So I think right now what we're seeing is a little bit of a thawing out in pharmaceuticals, arguably, with the drug pricing conversations having been had and some regulations going into place this year. And I think some of the discussion or discourse coming from DC is now squarely on managed care, providers, other segments of the market. I truly don't think there's anyone in the administration that's willing to, or at least has come out publicly and sort of blueprinted a plan that is going to, tackle the issue, recreate the healthcare system, what have you. So I think this is just an ongoing conversation we have.
Is there any reason for investors to look at these stocks?
I don't know. I think eventually, when you get these sort of visceral reactions to, single stocks and multiple stocks within a category, you let it breathe for a little while and then come back to it. It's really going to come down to what is the path for either a United or others in the peer group to sustainably grow earnings and show visibility. Now, I don't think we have that today. I don't think we're going to get that tomorrow. But I think one thing that's interesting is that the CMS Medicare Advantage final ruling will come out sometime in April. And so maybe there's a trade into April where you can go long this group for a little while in, aspirationally thinking that Medicare rates are going to be a little bit better.
We'll see. Jared, thank you as always for your insight and perspective on this group. Appreciate it. Thanks
a lot. Appreciate it.
Coming up, we're going to track the top analyst calls on Wall Street. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of Pfizer, CoreWeave, and Zoom. First up, drug makers Pfizer and Merck & Co. Cantor Fitzgerald upgraded Pfizer's price target to $27, up from $24. It also upgraded its price target for Merck & Co. to $116, up from $83. The analyst maintained its neutral rating, though, on both stocks, and both are set to report earnings next week. Now, ratings on the street are largely mixed. Pfizer has 14 buy ratings, 15 holds, and 1 sell, while Merck & Co. has 21 buys, 11 holds, and 1 sell. Next up, CoreWeave, the stock's move higher continues this morning after Deutsche Bank upgraded its rating on the stock to buy. On Monday, it announced an additional $2 billion investment from NVIDIA, and the analyst said that incrementally strengthens their longer-term view and further validates its technical leadership. There are now 18 buys, 13 holds, and 2 sell ratings on the street for CoreWeave. Lastly, let's take a look at Zoom because Wedbush raised its price target on the video platform to $110, up from $95. The analyst said, quote, it has increased confidence in the company's AI strategy across its large cohort of enterprises to expand its wallet share across that existing consumer base. Now, the average price target on the street is roughly $97. Keep it right here on Yahoo Finance because we'll be tracking all the latest market moves and top calls throughout the session.
Lululemon is under fire for selling leggings that customers complain are see-through. Yes, again, it's not the first time that Lulu has faced backlash for its clothing quality, and this time it comes as the apparel company is in transition, seeking a new CEO, and facing activist investor pressure. Yahoo Finance's Jared Blickery spoke to Adrian Yee, Barclays consumer discretionary analyst, about how the retailer could get back on track.
Adrian, thank you for joining us here. How does Lulu right the ship? So as we said, the CEO is out at the end of January, but the founder, Chip Wilson, has said there's been a loss of cool, and this is the second time within a year that they've had these quality control issues.
Yeah, so this isn't even the first time that we've had kind of a product issue. Recall back in 2013, the company had to remove, a significant portion, a double-digit portion of its bottoms because of quality control issues. What I would say is, now what's happening is we're much further on as a company, as an organization, and really what's happening is there's almost a panic to get newness to the market. So they talked about infusing about 35% newness starting in the first quarter of this year and kind of rolling throughout the rest of the year. What that does is it doesn't give you a lot of time to test in the marketplace and get feedback. And so that's one of the risks that we see them facing this year.
Well, and apparel in general hasn't had the greatest start to the year. I'm talking about stocks, and you're in the consumer discretionary analyst group here. Talk to me about what it would take. Are these macro headwinds? Is it just cyclical? What does it take to get some of these stocks back on track?
I think a couple of things. These stocks hit kind of bottom, right? A near-term bottom in probably the October, November timeframe. I mean, this was the worst place to be from consumer discretionary goods. If you look at the sector relative to all the other sectors, it was a straight kind of like do not touch. And I think at the back end of last year, we realized that some of the tariff pressure was known. It was in the stocks, or at least it was in the models, right? To the extent that it was going to be a net neutral as we go into the full year, worse in the first half, better in the back half, we're going to get price increases. So I think really what you need to see here is that the demand as we go into the first quarter, that there is stimulus that is driven by the one big beautiful bill, as well as past Fed cuts, right, to stimulate the consumer and to drive them to continue to spend, notwithstanding the fact that basically your entire wallet is going to be inflationary, right?
Yeah, well, and not only that, we just had a winter storm pass, which is definitely lowering consumers or separating them from the ability to spend that money at stores. I want to shift gears a little bit, and we're going to talk about Nike. I just saw this header across. They're terminating 775 employees as it accelerates automation at U.S. distribution centers. And I don't know if you've read the report, but just talk to us more generally about the influence of automation and maybe AI kind of creeping in and reducing headcount and maybe increasing profitability.
Yeah. The first place that you're going to see it, I mean, there's a lot of talk about agentic search and how that was up 700% during kind of Black Friday. I mean, we're really starting to embrace the information, the data flow. I think what you're really going to see, retailers, generally speaking, historically have been sort of behind, right, in terms of investing in all of this technology, et cetera. The functional aspect of digital and data, that has kind of forced people to gather that data. So the good part about omnichannel and digital is you have that data there, which they otherwise may not have had if they were only doing brick and mortar. And so what I would say is the first place you're going to see it, and the easiest place that you're going to see it, is inventory management, store payroll hours, kind of managing those hours, and through the supply chain, as you're mentioning right here. So I do think that the first place is cost reduction, and then the second place, which takes a little bit more personalization, finding out about that customer, doing a personalized search, and customizing their CRM systems, that will really drive the demand side of it. But I think you're first going to see it most easily deployed sort of on the cost side of things.
I appreciate that. And as we head into earnings season in a few weeks, we're going to really get the retail crowd and a peek into what's been happening over the holiday quarters, and also, more importantly, a look ahead into the rest of 2026. What do you expect? What are some of the tailwinds, headwinds, et cetera? Yeah,
the tailwinds are freight is your friend, right? So oil's been coming down. So that's a new tailwind that we have kind of this year over last year. If you're an apparel manufacturer, cotton's your friend. We've seen kind of, slight, benefit in the third and fourth quarters coming from those who do a lot of denim, like a Gap. And then I would say the other tailwind is going to be as we anniversary the back half of this year, you're going to get the kind of stabilization of the pressure, right, of that tariff. Tariffs seem to be, the discussion is sort of net to the things might be a tiny bit better. So that's also kind of, not worse. And then the last part of it that kind of is the overall is what happens to the consumer when we raise prices 2, 3, 4% starting this season. And that can be kind of offset by some of the stimulus that we expect to come to the consumer. So net, we're looking at a flat to expanding margin year in 2026. We're not entirely kind of negative on this space. And what I would say is we get incrementally more positive as we head into the back half of the year. So we have a risk on for consumer discretionary. And we definitely think that you need to have some of that in your portfolio in the instance that we do get a little rollback on some of that tariff pressure.
Ton of insights there. Really appreciate your stopping by here. Thank you, Adrian.
Thanks so much.
Coming up, General Motors expecting a strong year ahead, what the path forward looks like for the automaker as it pulls back from EVs. Stay tuned. You're watching Market Catalyst. General Motors shares are trading at a record. That's after the company says it's expecting another year of strong financial performance. This comes as the automaker sees higher demand for SUVs and trucks and pulls back on its electric vehicle plans. Here's what the CFO told our Subramanian earlier.
If you think about where we've been for the last few years, we were tooling up and scaling up to produce 1 million EVs a year because that's what the government was requiring under the prior administration. So with the changing regulatory environment, we see a much slower path to EV adoption, but we do see a path. As far as demand goes, I think it gives us time to get the charging infrastructure up and ultimately get people more accepting of EVs.
Joining me now, Tom Narayan, RBC Capital Markets lead equity analyst for Global Autos. Tom, it's great to see you. I do want to dig into that EV question, but first of all, just taking a look at this quarter, the buyback, the dividend increase, it seems like investors got kind of most of what they wanted here.
Yeah, I would agree with that. I think into the quarter, there's been a lot of negativity on autos, a lot of geopolitical questions and tariffs, et cetera. And some worries about U.S. sales. Would it be down next year and all of this? And so I think these results, first of all, just on their own, they were great. Make no mistake. But even beyond that, I do think there was some surprise factor to the positive. It's probably showing why there's an outsized positive performance.
Yeah, it seems that way with that 9% increase. I mean, the shares were already running up into this report, right? We've already seen some increases there. So what does this reaction imply about now what future expectations are for GM?
Yeah, I guess I was talking about just the past couple of months, how the stock was trading. But I think it's a very positive picture. We've been talking about this now for a little while now. We're very constructive on the U.S. auto market. We don't think a car is a consumer discretionary purchase. Unemployment is at record lows. GM is also specially positioned because they have like 60-70% of large SUVs and pickups. We know that the strength of the U.S. economy right now is on the higher end, right? Not on the lower end. That actually benefits GM. They're doing this big buyback. There are a lot of things also that came out on the conference call, which I think are important. A lot of people are worried about memory chips, right? And GM said, you know what, like, at least for now, things are okay, right? They put it in their kind of commodities bucket, and it wasn't even the biggest element there. And then the other big story is EVs, which I'm sure you're about to ask me about.
I am about to ask you about that, Dom. I thought it was really interesting that Jacobson painted this as, well, the government was making us do it, as though there's no consumer demand. There is still some consumer demand for EVs. Do you think that GM has sort of right-sized or corrected the course for their EV strategy? Do you think they've done that properly?
I mean, I think they've really done a great job, honestly, in how they've structured their EV deployment. They were later, right, than, let's say, Ford, for example. They have plants that are flexible. That's really important, right? Because, you know, for example, at Orion, they just, instead of making electric pickup trucks or what have you, make more ICE pickup trucks. That is a huge luxury to be able to do. And then, you know, in Ramos, they're making the EV Equinox and Blazer, and they can just shift production to ICEs there. And so I think it's also a smart way they put together their EV strategy. They still believe in EVs, right? Longer term, I've been saying this for a long time. We did a lot of work on this. I think one of the big reasons why there's an EV slowdown, sure, there's policy, but it's also like you can get really cheap used EVs right now. Why would you buy a new one, right? So there's a huge glut of, leases from 3 years ago that are hitting the market, and you can get really cheap used EVs. I think that's a factor. There is EV demand. People do want these products. We'll get there, right? It's just right now, GM can very smartly shift production, and lower its EV costs. That was a big driver of their guidance that they gave, is coming from lower EV losses. And their 2026 EBIT guidance is coming in way ahead of 2025, and it could go even higher if we get a USMCA resolution. So I think that's really what folks have really focused on.
And Tom, as you mentioned, unemployment relatively low. Consumer confidence, though, isn't great right now. We know that the consumer spending that is happening because of the top income cohorts in the U.S. So what does all of that imply for vehicle purchases this year, and specifically new vehicle purchases this year? As you say, it ain't just EVs, right? You can buy used vehicles generally at a lower price.
Yeah, that's true. But, it's interesting if you kind of take a step back, right, and you look at the pandemic, and you look at the years after the pandemic, and you look at things like age of fleet, scrap rates, like how many vehicles are scrapped each year, looking at the past 50 years, and you extrapolate that, right, from pre-pandemic to today, you actually come up with a deficit of cars that were never purchased of about 5 million cars. Each year in the U.S., they buy around 16 million. So there's just a huge amount of cars that were never bought because of the pandemic. And like I said before, this isn't like McDonald's or Chipotle or whatever, right? You have to drive to work. If you have a job in the USA and you have to drive, you have to buy a car, and the age of the vehicle does matter, right? And for GM, they're selling cars more on the kind of upper end of pricing overall. So I think they benefit from this kind of higher end consumer benefiting, and the fact that the car ultimately, I just don't think it's a consumer discretionary purchase.
I mean, I took New Jersey Transit to work today, and I wish I had driven a car, Tom. On another note, for those of us who are relying on transit these days, would you say that GM is I know you have an outperform on a number of names, GM included. Would it be your top pick within the sector right now, or would you point elsewhere?
We really like GM, definitely, but our top pick is actually on the supplier side, especially suppliers levered to GM. One example is American Axle. This is a supplier. They are doing an M&A, a deal with a British company. And there's a lot of synergies there that I think folks don't really appreciate. And they're going to benefit from the volumes that are going to come out this year and all the stuff I've been talking about. So we really like the U.S. supplier space. But yeah, GM is definitely a story that's going to work out continually. And we do see a tariff resolution as a big catalyst, especially Mexico, that should help the U.S. suppliers and OEMs like GM.
Tom, great to see you. Appreciate it.
You got it.
Take care. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance coming up.